Hello and welcome back to another episode of Starting Your Investment Journey audio series. My name is Abiodun Adelu, and if you are listening to this for the first time or if this is where you're starting from, I want you to know that the mission here is to help people build successful and meaningful lives through better decisions about money, about work, wealth, and personal growth. Now, in this specific episode, we're going to talk about debt instruments, right? So for most people, when they hear the word debts, right, D-E-B-T, what they think of is that they are owing money to someone, maybe or to an organization, maybe a loan or a credit card, a mortgage, or a personal debt. But in investing, a debt can be something very different, right? It can mean something that owes you money. It could be that someone owes you money. And so you're not just seeing it from you are the one that is owing someone. You can see that someone owing you money. So imagine that a friend comes to you and says that, can you lend me 100,000 naira? I'll return it in 1 year and I will add 10,000 naira to it as a thank you. Now, would you be interested in that? Maybe or maybe not. But one thing is certain, you have just been offered a debt instrument. What's a debt instrument? A debt instrument is a financial agreement where one party lends money and another party promise to repay it with interest. Now, in simple terms, what does that mean? It means that someone needs money, you provide the money, and they promise to pay it back later, plus a reward for waiting for your money, right? So most people spend their lives being borrowers, but what debt instrument allows you to do is to become the lender. So instead of paying interest, you receive interest. And that is very good, right? So instead of just owing money, you are owed money. And that is why I like to call it playing the role of the bank. So see yourself as you have become the banker. Now, why do borrowers exist? Why do people borrow money, and why do some people lend money? Now, let's think about it like this. Why would anyone borrow money, right? Because they need capital today. That's it. They need money today. So a business may want to expand. A government may want to build roads and they need money to do that. A bank may want to fund to support lending. So they want to borrow money from you so that they can borrow it to others too, right? So they need money now, and you, on the other hand, you have money now. So a debt instrument connects the two of you together. Now, let's look at how debt instrument works using a simple example. Now, suppose that a company needs 1 billion naira. They need 1 billion naira. So instead of asking one person for all of the money, another way they can do it is to raise the fund from thousands of investors. Now, each investor contributes a small amount. 1 million naira here, 500,000 naira here, 300,000 naira here, and the company agrees to repay the money later and pay them with interest. That agreement becomes a debt instrument. Now, let's look at some common types of debt instruments. Now, some of them are government debt instruments, some of them are corporate debt instruments, and some of them are bank-related debt instruments. Let's look at the most common types. We can't list all of them, but we'll look at the most common types. Now, number one is treasury bills. Now, I know you've heard about treasury bills before. Maybe you've probably seen someone advertising it online, or you've seen it somewhere and you're wondering, what is this treasury bill and how is it different from shares? Is it just like shares too? Now, treasury bills are short-term debt instruments issued by governments, and they are short-term instruments, right? So they're usually for maybe 91 days, that's like 3 months, 182 days, that's like 6 months, or 364 days, that's 1 year. So that's how they are calculated. 91 days, 182 days, 364 days. Now, think of them as lending money to the government for a short period. Now, government use this money to manage short-term funding needs, maybe like their capital projects. And they are generally considered the lower risk debt instruments. Why? Because government have taxation powers and significant resources. Therefore, people feel like government will always pay their money back. They feel like government will not take their money away. Number two is government bond. That's another debt instrument, right? Now, they are similar to treasury bills, but they usually last longer, usually more than a year, right? So this one too, you are lending money to the government, and the government agrees to pay you back the capital, which is the principal, and pay you interest. Number 3 is corporate bond. In this case, instead of borrowing it to the government, you are borrowing it to a company, right? You are lending money to a company. So why do they issue bonds? They issue bonds to expand operations, to build bigger facilities, or to refinance existing obligations. So generally speaking, the stronger the company, the lower the perceived risks. So if a known company, a strong company that everybody trusts, if they are selling corporate bond, it is easier for people to trust it because they feel like this company is not going anywhere. We know them, they have a track record. But if it is a company that you really don't have, you don't know them like that, then you are really careful to buy their bond, right? So the lower the risk, the lower the interest investors usually demand. So if the risk is low, investors can take smaller interest. But if they feel like the risk is high, they would want to demand higher interest. Number 4 is fixed deposits. I believe that many people already know this one. So you place money with a bank for a fixed period, and the bank pays you interest. So what many people don't realize is this. A fixed deposit is also a debt instrument. You are effectively lending money to the bank, and the bank promises to return it later with interest. Of course, your money is not just sitting down in the bank. The bank is using it to also make money. And that is why they have some part of it to share with you as interest. Now, why do many investors like debt instruments? Like I said, we have equity, we have derivatives, and we have debt instruments. So why would people want to prefer debt instrument, for example? Number 1 is predictability. It is easily predictable. You know when payments are due, you know how much interest will be paid, and you know when your principal should be returned. Unlike the other classes, right? So this one is more predictable. Number 2 is lower volatility. So debt instruments generally fluctuate less than equities, right? So they don't fluctuate as much. Number 3 is income generation. Many debt instruments provide regular income. So this can be attractive to retirees or conservative investors. I have people that they don't like anything that is high risk investment. So they will prefer maybe a treasury bill or a bond. That one, they are very sure that they can get their money back and it is very stable. So it is a form of income generation for them. Now, here comes the important part. Everything in finance involves some trade-off, right? So debt instruments are usually more predictable, but they also have less upside. Now, let's imagine 2 scenarios. Now, let's say scenario 1, you lend money to a company. Scenario 2, you own part of the company. Now, let's compare the two of them. If the company becomes widely successful, right, the lender still receives the agreed interest, but the owner participates in much more of the upside. So if you lend money to company A, even if they make so much profit, what you are getting is still the interest that you agree with. But if you are part of the owners, if you buy shares on the other hand, the bigger the business, the bigger their performance, the better their performance, the more dividends you get, and the higher the value of your shares. But the same thing is also true if they also lose money, right? If they lose money, the debtors will get their money faster before the shareholders. So that is why debt is generally considered lower risk than equity, but it also tends to offer lower potential returns, right? So it is not completely risk-free. Let's be clear about that. It has some risk too. Now, what are the risks that are associated with debt instruments? Number 1 is that there can be default risk. The borrower may fail to repay. And that's why people usually go for government debt, because they feel like it is surer that the government is going to repay them. Number 2 is inflation risk. Now, if inflation rises faster than your interest earning, your purchasing power may still decline. So let's say they promise you a 15% interest, and inflation rate move from 10% to 20%. So at 20% inflation rate, even though you are gaining 15% interest, you are losing money at 5%. So that is the second risk if inflation rate grows faster than the interest rate. Number 3 is interest rate risk. right? So sometimes some interest rates changes in the market can affect the attractiveness and value of the existing debt investment. So you have already bought the debts when the market interest rate was maybe 10%. Now the market interest rate has moved to 15%, but you are still tied to your 10% because that is what you agreed to at the beginning. So that itself is a risk. But here's a simple rule that helps you to understand debts very well. Think of it as renting out money. So you temporarily give someone access to your capital, and in return, they pay you for using it, right? So it's not about ownership, it's about lending. So when you're investing in debts, you are not the owner. You are not even sharing, you are not sharing profits. You are part of the creditor, right? You are the creditor. So your focus is not on growth, you're focusing that repay me back with interest. Right, so that is it. So you are more particular about whether they can pay you back or not. So that is it. So you are not a lender. I mean, you are not an owner. You are a lender. So that is what happens to it. So now, our next episode, we're going to look at what happens when you don't want to be the lender. What happens when you want to be the owner, and that's where we're going to go next. Thank you for listening. Always remember: learn before you invest, build before you buy, and always think long term when you are thinking investing. I'll see you in the next episode.